Good morning, everyone.
Good morning.
Morning.
How is everybody doing today?
So far, so good.
Okay.
How about you?
Good. Good. We're having already so much fun, right, Trevor? Just having a blast, doing the things.
That need to be done.
Yes. Well, all good. All good. It was just kind of funny earlier today. It felt like my voice was like cutting in and out. So I hope I am not coming down with a cold because that would be a party pooper.
Yes. There is some summer crud going around.
Mm-mm. No, thank you. It's a good thing it's almost weekend. Time to go and rehydrate.
Yeah.
We'll give it a couple more minutes for everybody to trickle in and get going. Oh God, it's such a treat. We have Brenda in the house. Oh, so much fun. We don't nearly get to hang out as much as we need to. Morning, everybody.
Morning.
Okay. I'm expecting a couple more people to pop up in today. But let's give it like another minute and then we'll start kicking things off for our contracted close day. As we are waiting, any pressing urgent questions on underwriting that are holding you back? Nothing? Okay. All experts love it. Perfection. Mhm. So in short today we're actually going to take quite a bit of time talking about a new development project that is kicking off. You may or may not have heard about us. You may not have heard about us talking all that often during the calls, but for a couple of months now, we have been in negotiations to buy a piece of property that is part of a bigger development to build a new development of retail on there. Very excited. It's called Candela. It is based in Richmond, Texas. So that is southwest of Houston. We are, in short, we're buying 10 acres over there. And that 10 acres is part of a 463 acre development. So we are the only retail piece in there. We are surrounded by lots of single family. There will also be some multifamily built, a little bit of commercial space, where I just have to say it, Brenda's going to be super excited about. The pickleball business is coming into place. So I know that's a pretty fun idea. I love it. See, we can already just send over a resident expert. Brenda, do you want to go do inspections and go and check out, not just like our stuff, but the pickleball stuff too?
I'm ready. I was born for that. Let's go.
I love it. I smiled so hard when I heard that yesterday. But yeah, basically Candela is our new fun little project that is kicking off soon. We actually just got our signed contract back yesterday, which is awesome. So things are going to go very, very fast from this point on. We have been doing lots of preparations on our end. So you guys shortly will see the underwriting that we have on that. We'll talk through the timeline on this, and we are still working on the deck, but more photos to come soon on that. But just as a fun little teaser, I do want to share a little bit of schematics, just so you guys can see what we're all a bigger part of. So right here is the entire development that we're going to be a part of. So Johnson Development is working on the 461 acres in Richmond, Texas. We are basically having 10 acres right here, about 1,000 feet of frontage on this big road. To put that into other terminology, it's about 3 football fields long of frontage on the road that we do have. And so basically this entire thing is going to be ours. We are in total going to build 2 retail buildings on there, totaling 61,444 square feet. So we can host quite a bit of stuff in there. I will show you the initial drawings that we got back from the architect in a little bit. But just as a bit of a reference, at the moment, phase 1 is already built. Phase 2 is already built. And if you guys go and take a look down here, that's quite a bit of single family home lots. Phase 3 is in progress and is set to be finalized and completed by Q4 of 2025. That is going to be right around the same time as we are finishing our retail right here. For phase 4 and 5, we don't have a completion date for those just yet. The school that you see up here is already there. It's already operating for, phase 1 and phase 2 areas. Brenda, our pickleball business, is going to go in place right here in this commercial area. And then there will be a multifamily lot or building that will be built right behind us. That is going to include about 200 to 300 units. So they're also still finalizing.
Do you want to show them that picture? If not, I have it pulled up.
Yeah, let's do it. This is so exciting. We're
So if you
very
think of that little box that she just showed you, this is where our retail will be. So all the housing development was over there. the more high-end homes in the front. And then in the back of us, roughly 250 multifamily homes, which have their own entrance. But obviously will be big clients for the retail. And then the retail is basically it's 4 buildings, and in the middle this is like a green space. So the goal is these 2 larger end tenants will be restaurants that will have a nice common area.
Yeah, the reason why we are so excited about this project in particular, Richmond is definitely still a very growing city. So if you're currently looking at the population is low, but it is growing at a pace of about like 4% a year. And as you can see, if a big developer goes in here, there's definitely more growth coming. In this development, we will be the only retail space that will be in that location. We have so much visibility straight from the road. So we are very much expecting that this will have a power in and all to itself. There's not a lot of other retail space there. So people that are already living nearby, they're probably going to come to the nearest retail area that is available to them. If we would look at this on a map, of course I closed that out. So we are basically for a little bit further down from, I want to say Sugarland. So let me pull it up on a map so you guys can take a look at that. This is actually our address. So at the moment, there's not yet something there. If we start to zoom out, you already see we have some developments up here. And then it definitely is building out from there. So we are southwest, more west from Houston, somewhere between like Fulshire, Richmond. Officially, this is the Richmond address.
But we're dead center between Katy and Sugarland, which is 2 pretty hot up and coming Houston areas.
But one of the good thing about this, the project that we do, so we look at the macro, then we get the micro. Within the micro, there's 2 kinds of land, right? One, we go in with our own assumption and trying to move that forward. And but this particular project is staging matters, right? I will talk about the staging. So let me step back before I get to it. From the risking perspective, one of the things that I picked up when I went, hold on, let me see. Ellen, do you have that other email that Bo sent out that has the apartment on the back?
Oh, actually,
So right,
yeah,
yeah,
just
thank
had
you.
that up.
So okay, so it's about 20 acres tract. 14 acres each are going to an apartment company. It's called Alliance Residential. They do garden style apartments, and that's their bread and butter. They've been there for long enough. They know it. That's their cookie cutter stuff. And when I met Mark, the developer who's leading this one, he was talking about how they're underwriting and all those things, beautiful things, right? One of the coolest things that I've seen, they put a proposal together from I want to do it to I'm going to buy it in less than 4 months or so. And that's almost a little over 200 units. So they think about that. They put a $30 million deal in it less than 90 days. And that was so quick, so fast. So when we met with them 2 weeks ago, me and Bo went to their office. One thing he said, we like Johnson Development's projects because their home prices don't go down. It's not I was like, huh. And that statement, I was thinking about it. Think about it this way. Johnson is one of the largest developer, and they don't do cheap projects. They don't go figure things out. They have a lot more upside down view. And this is in their neighborhood. A property on the right side that you see on the corner, on the other side of Johnson's, on the other side to the northeast quadrant is all Johnson. So one of the area de-risking is Johnson's houses do not go down in price. Their clientele is their clientele. So potential degradation of income, that's not happening in that area. That's an interesting point that I picked. I was like, oh, that's good. Then all I have to do, follow Johnson, right? It's just, you just go over wherever you go. So that was another thing, that we picked up over time. So all in all, R1 has done, I don't know, plenty of projects in the 1093 from the very beginning. They're in Rotherburg. They know the area, they know the county, they know the city, and that's it. There was a potential risk on the northeast side. There was a carve cut that we thought we had to have it, but now we don't. That went to Alliance, so we are off the hook from TxDOT. We have a carve cut already in the middle, and we should be fine. So all in all, the project risk and perspective, we should be in a pretty good spot. Civil has been engaged, architect has been engaged, the permit runner has been engaged, contract was signed, so it's a full on board going right now. So 25K was wired in yesterday. We're gonna wire the other 25K tomorrow or Monday. So it is locked in. We got 6 months or less to close. Our goal is to go straight to construction and finish the race this year. Stopgap mitigation, if we cannot do it for whatever reason, then we'll take a land loan, close the deal. That's gonna add about a couple of months to finish the race and go to construction. The speed perspective, what we're trying to mimic is the Ellison project. If you're in Houston, if you can Google Ellison, right opposite of Target, Realty One bought 27 acres, about $35 million from with the family office. The speed that it went to, November last year, they put the property under contract. Right now, building is up in the air. That was, 17 miles of piping already went underground. That's some beastie project. That's a $70 million project, right? So we're trying to, from the process side, we're trying to do the same speed on this one. We may fail, but that staging is that speed. Go in heavy, go in quick, wrap it up as fast as you can as you go. That's why a lot of the legwork already happened. So obviously on the development side, we have risks, but we're trying to mitigate as much as we can before we even get to the closing. So by the time we get to the construction, we should be in a better spot. And the definition of better spot is we have submitted the plan already, and we have one first feedback from the county or from the city. So always remember, when we go into development side, the first feedback is the most expensive and the toughest one. Then you know how to play the course. So we're trying to get into that spot where we are ready to submit once, if not submitted once before we come back out. So always first feedback is that's what you want to solve for. If somebody says, I want to de-risk it, so your de-risking category is the first feedback, and we're trying to get to that first feedback within 6 months, at least before we get the construction loan. Thank you, Ellen. I kind of jumped in. I'm sorry, I had another call. I had to wrap it up a little bit late. So
No, this is
Okay.
exciting. Before we dive into all the numbers, I do want to show off
Awesome.
one of the pretty things. So we did already go over the schematic, but we have our first design. Do note
Yay.
the change, but doesn't like this look gorgeous? So we'll have two big buildings, as Trevor already mentioned. We will have some green space in the middle. So if you have a beautiful restaurant on this end and on this end, I would personally love to go and have some food over there. But this is kind of what it is looking like. So here we have our 3 football fields of road frontage. We are in total across the 2 buildings with a breezeway in between. We'll have 61,444 square feet of retail space, plenty of parking, and this is kind of the look and feel that we are going for with this design. Any questions from you guys before we hop into some underwriting and some timelines?
Can you, Ellen, go over the timelines for Candela again?
Yes, we will.
So,
We'll.
okay.
Or is that something you're going to discuss later?
No, we are
Yeah.
going to discuss that today.
Oh, okay, cool.
Yeah.
Shar, if you want to take that off, or
Well, it's good. So I met the architect and the civil engineering team last Thursday. Me and Ajit went in for another project, and they were there. Just wanted to get some alignment on the architect and civil. Now, full disclaimer: this is going to be our 3rd development. Under Massive, this is our 3rd development project, 4th development project, and personally, this is my 8th. So we have been through quite a bit of the ringers per se. So I want to get my calibration out there. So me and Ajit went out there, had a good conversation with Jason, who's the architect. He joined the Realty One partnership last year. And then what's the other guy's name? Joel. Joel runs the permitting process and everything else, and Jason does that. So we went back and aligned. A couple of things was alignment. Some of you guys are engineers. Well, when I grew up, my mentors were always like, hey, everybody can write, but not everybody handwriting is beautiful. Takes the same amount of time and ink, right? So when I went to him, I asked him how many projects does he do a year. He said he does 30 projects a year across Texas, and then he does all the things with R1. So my baseline was, hey, every time we give you a project, I'm expecting a very nice layout off the gate. So if I have to remind you that we're looking for another revision, then and I'm not in a good spot, because the design that we shared, that was a third iterations of it. So we had that alignment. He said, absolutely no big deal. He dropped the ball on the first one, but he's not going to drop it. And the second thing we ask is that, hey, de-risking side of it. When you come in saying that you have done hundreds of projects in the last 3 years, then I expect you to do some projects in that area. So when you come in, come back from that advisory side as we look into it. So they agreed. And so it was a good conversation as you go. Point is, if you're working with somebody, especially on design side, go shop the office, ask them detailed questions, get alignment, then we go. You want to review the timeline real quick then? We have two timelines, right? That we're going to talk about. One is the investor relation timeline, which is what happens now till next 60 days, next 90 days, 120 days. Then we have the project timeline, what the project would look like. And we're going to start here. We're going to look at the next 4 months, and then we'll get into the project underwriting as you kind of go. So Ellen, take it away. Oh, on that note, so every project that we do, we're in a contract to close mode. So due diligence is done, pro forma is done, contract is done. Now with the contract, we have a starting and we have an end clock that is ticking. At this point, we go to contract to close, or C2C, we call it. And this is the C2C, and every time there is always a schedule master who will drive all the schedule to get to that timeline. Because when you get to this phase, you got equity raising, you got legal team, you got insurance, you got construction, a whole bunch of other stuff will kick in. This schedule kind of combines everything together and puts us in a spot. So let's look at it from the money perspective. Let me see. Okay, so if we look at row 67, that's the first thing. That's where we were. LOI was accepted, and then date and PSA was signed on 24th. And then by the time we get to that, that PSA signed, we have done the pro forma. From the acquisition side, they have done it. And as the acquisition happened, PSA happened, they also got signed off from us, the partners, because we're going to guarantee the loan. This is going to be a recourse loan or semi-recourse loan. So my balance sheet is going to go into that alongside with Joe, Pat, and Bose. So us three, we're going to guarantee. So it's a lot. So we checked that out. So before Sanjay accepted the PSA, he had signed off from me and also Mike to make sure that we are comfortable with the underwriting, we're comfortable with the forecast, we believe it's investable project, and the equity side we are also ready. So that's already happened. Now, as a part of the process, Ellen is handing over to the equity team, which is Mike's team. So Sanjay's team is handing over to Mike's team. On the acquisition side, you're handing over. As a part of the handover, we have a checklist. We have investor relations deck, we have everything else. So Maria, Trevor, and everybody else, they are going through the, getting in sync today until tomorrow. So after tomorrow, 100% of our team who's going to be working on this project, they would know the underwriting all the way, so we can talk and be at the same page. So if you're raising, and assuming you have a property under contract, you are going to raise, you have a deal team. You got to make sure that everybody in the deal team sees the pro forma the same way, understand the calculation the same way. Otherwise, you'll be opening up the door for undue questions and the wrong time down the way. So everybody must be in sync, and that's the process that's happening, and it's happened. Then we are finishing the we finished the row 69 underwriting valuations. Number 70, that's gonna kick off. The 70 has two things. We asked the architect to give us some better pictures some little bit more bigger pictures so you can put them on the deck. And drone shot, we'll do a drone shot, but we don't know it's an empty drone shot, how that's gonna play out. Well, but we'll figure something out as we go. And then row 71, Trevor is working with the investor deck for everybody else. So very similar to Grove, we'll have the deck ready for everyone. And then we can kind of go. So very similar to what we did with Shirayu, we'll do with you guys as well if you want to raise as you go. On that note, the goal is get what we understand. If you are raising or if you are not raising, but thinking about raising in future, get in action. The faster you figure out the feedback from investors, first as you get comfortable about talking about this deal, to get your email, website, everything set up, better it is. So we should have deck ready by Trevor, when? Next week sometime on the
Yeah, next week.
next week. Okay, sounds good. All right, then the landing page, we should have the landing page over the weekend. So that's gonna be ready. CFP, Riza is not here, Mike, but we have a full-time team member, Riza. She has joined us about a couple of weeks ago. She will be managing everything cash flow portal for everybody. So you will see Riza managing that more. So which is from our side, investor onboarding, partner onboarding. Your side, when you making sure that you have access as a GP or co-GP, all this other stuff, she's going to help us as you go. Our request is please allow some time for us to get grounded. Once you get grounded, that's going to be harsh. So we as a team right now, we have a full-time focal point for cash flow portal to support everybody. And right now we're at 74. That's what we're working on. So Mike is working on to figure out with Maria, or Trevor and Maria, it's aligning the GP team on the equity side on it. Legal paperwork has been kicked off already. We gave the templates to the attorney. So goal is to have those legal paperwork done, received 2 days before the first webinar. That gives us the time to go onto the cash flow portal and get everything ready. So the first webinar, we're ready to receive checks from investors. It took us a lot to get here. We always get close to it. And when you run a deal, you want to make sure you execute it right. So the first webinar we got to make sure that if we go backwards, we got to make sure that our legal docs are ready. So we are ready to collect investors' money the day or the night of the investor relations meeting. Bank account being set up. Marketing team is prepping for the webinars. So we got this schedule, and I'll share how the marketing is going to work. And that's where we're at. And we go online on Monday. Sorry, on Sunday is Sunday the 8th or 6th, 7th, sorry, 8th. Week from now, our marketing begins on go. So the way we do the sequence now is that we send out an email on a Sunday or whatever day. The next day we drop a ringless voicemail. And then we do a follow-up email, we drop a text. So we are omnipresent in a sense via all the channels, text, voicemail, and email, follow-up cadence, so we can build up the momentum into the webinar. One thing we do know as of now, it takes about 3 weeks to build the momentum from the 506B and a C side. And in this case, we're compressing into 2 weeks. But we think we have another stopgap mitigations, we should be okay. So data point, 3 weeks to build up the steam to get to that number. So nothing happens instantaneously. It's 3 weeks from you start communicating, and then about 5 weeks before the webinar, you need to start prepping. And that's the timeline. First webinar on the 6th. Sorry, Maria, go ahead.
And to Shire's point with that, it does take a while to get our information to our 506B people, but all of you who are raising on Grove at Pinemont or who are thinking about raising, you have taken the time to find your 506B list. And so since you've already done that, you've already found that, you've already reached out to those people, you already have that list done. So that's the list that you're going to be reaching out to for Candela, which means you're ready to go. You really don't need to take time to do that. You have that done and you've already done the work to get to that point. So that's the best part about doing this, is that we're just going to take what you've done at Grove at Pinemont and go right into Candela. The nice thing is you'll just need to know the differences in these deals. The best part, it's a quicker turnaround, the 3-year turnaround. Yes, there's be no depreciation because it is a new development, but those quicker things that you'll need to know, Those are going to be what helps get your investors to these webinars. So you've already done the preliminary work. Remember, I know we have our infrastructure put in a little bit different than you guys. I know you're just starting with that, but that doesn't mean that we can't hold off and wait until the next one. We're going to go now. Make sure you're tagging your people, putting in those 506B tags on your people now. That helps you later. I promise. Promise it helps you later. That's what we're doing right now. We're going back and tagging people that are 506B investors. I wish we didn't have to do that. I wish we weren't going backwards and tagging people that we already had as our investors. But you guys are at that point where you can do that now and help yourself out for the future and get ahead. So get ahead of where we are. And that's going to help you guys when you are having 12,000, 13,000 investors in your database. That's going to help you out well into the future.
Thank you. Appreciate that, Maria. So I'll run down the row number 82 or so. So 82, 83. So for us, 506B side, we'll have 4 webinars. And if you look at column I-79, that 2 days and 7 days, and right there. So we're tracking how many days in between. Sorry, not column G. You get to see that how many days. So from first webinar to second webinar, it's a week. One is a weekday, one is a weekend. Then second to third, we have 2 weeks out. So we do bam, bam, then we take a pause. But then it's a long stretch. So in between that 2 weeks, we'll try to plug in another meeting somewhere else. But all in all, we want to execute 4 506B from the massive side. What is not captured here that if we are working, we are working with some of you to create and support your webinars. That is not here because I'm looking at that side. So from your side, your timeline, our timeline should be synced up until 77. And then from 77 till 84, you have your schedule. So think about this, all things will lead into a conversation and you want to have one-to-many conversation and multiple times. So start framing that up. We're sharing because up until row number 77, it's all same timeline, prep, then 79 till 84 is the execution. You need to have your own timeline between that window. That's because on row 84 or the 10th, middle of 10:15, we're going to stop 506B. We're going to go to 506C. So that's the any 506B that you have is there. So you have a month and a half, roughly 2 months, roughly 2 months or so our time, which is 506B. Then we stop, retire the 506B chapter. We jump onto 506C chapter. Now, you have seen on Grove, we are running on a schedule, or when you run a project, you run the project on a schedule. The schedule should mimic the expected money at the same time, that's why you see about row number 84 and 5, that we're going on paper 7.5, we'll be end up closing the property at 6.5-ish. But on that note, if everything goes all right, and then expectation is row 84, we should have $2.5 million docs signed and money is coming in before we close out the 506B. So when you run a large project, the money is at risk, time is at, it's not on your side. Then what's your scorecard? What does good look like? So we start mapping out those good looks like and de-risking point as you go. This project, we're doing it, but if it would be apartment projects, just like Grove or big, large projects, you got to be very clear. Those are my events. And if I'm successful in those events, which is webinars, how much cash I'm expecting in the bank account and how am I building that up? Because what we try to avoid, which is get to row number 94 and we have $4 million and we're scrambling for the last $2 million to close. What happens? Money is available, but that money will be expensive. They're gonna come for your throat in a heartbeat. So we kind of have that framework way early on. We said, put the pressure on the front so we don't have to negotiate at the very end. If we have to, we have to. We have backup plans, but that's the timeline. So point is $2.5 million signed docs and some in the bank account by the time we close down the 506B. That's the win. That's like what good looks like. Then we get into 506C. Understand though, from your data perspective, you could have, it is highly likely you have some of the 506B investor that you have, they're 506C also. So if you don't measure your data, it will be tough to kind of drive the conversation. So 506B means I have relationship. 506C means I can just go out to the public and drum the band, right? Or keep beating my drum. This is not the time just because we go to Facebook, money is gonna pour in, because it's not gonna pour in. We have enough data point to say it's not. At the same time, you need to be a little bit more tactical about it to understand how many of them are 506B, how many of them are 506C, and then measure the data as you go through. So that's there. Goal is to close right before Christmas. It's gonna be a Christmas gift to ourselves, and then we get to work.
And don't forget, when you're talking to your 506C investors that you have a relationship with, if they sign the documents while we're a 506B, they can self-accredit. So I know many of you heard me say how much I hate sending anything financial to anybody. This way you just click the button, you're self-accredited. You have to fill out survey for the relationship, but many accredited investors prefer that. So use that as a selling feature. Still doesn't mean you can market. It just means you can talk to who you know, and if they're accredited, to check that box.
You have international investors or people that you've had an extensive relationship with who you know do not like to go and talk to a CPA, or like I said, international investors that do not normally have to get an accredited letter, then this is the time for them to get into these deals. We do have a webinar for Horizon tonight. So Horizon, that's a way, post about it. That's the deal that you can talk about. Horizon's one that's a 506C. We can talk about that. You can put that on social media, and that's going to guide people into wanting to know what you're talking about. So use that as a jump off point, get people to the webinar, and then maybe start up that conversation of if they don't like Horizon, or maybe they want to invest in Horizon, maybe this will start the conversation for something else.
Cool. Thank you. You want to switch it to real quick on the pro forma?
Yep.
And we have Mr. John joined. John, appreciate you joining. So we're running the contract to close process. We have projects under contract, and things escalate the moment you get a contract, right? It goes. Ellen, you want to hit the high level notes in terms of the debt assumption and the how much capital and the return and the IRR and that kind of stuff, and then I can talk about the P&L and the assumptions around it. That's okay, please.
Absolutely. So the 10 acres we are purchasing for 4.5 million. We are going to purchase this ideally with a construction loan. At the time of closing, we are looking at about a 9% interest rate, 24 months of IO amortization, and this scenario is going to be 25 years instead of 30. We are planning on putting 30% down and have 70% of all of our construction costs covered by basically the construction loan. The big highlight, since this is a new development, is going to be the timeline and the CapEx. So let me start with the CapEx. This is basically our entire construction budget. The big thing is going to be our exterior. So we have our year one expenses line up here. The actual construction piece of the buildings themselves is going to be right around 11 million, a little bit over. There are some additional admin and legal costs that are related to the construction. So that would be things like doing an environmental study, paying our architect for all the wonderful plans, getting permits, platting, inspections done. Once we are fully up and running, we obviously do need to pay for legal commissions, and we need to have legal paperwork drawn up, as well as admin costs taken care of. Some of these things are moved to closing costs or to another year one expense line item. Another thing that we do need to budget for within our entire construction budget is the tax carry and interest carry for our year one. Obviously, while we are in construction mode, we do not have an income yet, so we need to make sure that is balanced out and that we can still pay our bills. And as any good contractor would do, we will budget in some contingency just in case, you know, something goes a little bit over in cost. Here on the left-hand side, this may be a term that you guys may not be super familiar with, tenant improvement allocation. This reflects to once we have our buildings ready and tenants are looking to move in, we will actually provide them a budget to do the necessary changes to make the space fit to their space for their needs. So a restaurant likely will put in something like a kitchen. If it is a beautiful boutique that's selling clothing and shoes, they may look for a little bit of storage area, fitting rooms, things like that. But there is a budget allocated for that, so they can do so. That's about $37 a square foot. All the way here up top to finish off the CapEx piece is we have about a 1% additional construction management fee in place to make sure that our construction team is paid. Last but not least, we are planning on some reserves, and we have some $150K in working capital available. Now, looking into the timeline, and we'll tie it in with the P&L here a little bit. So, like I already mentioned, we are planning to make this our wonderful Christmas gift, which means we do need a little bit of time post the closing to get everything prepped and lined up. Ideally, we are looking to break ground in Q1 of 2025. Construction is going to take somewhere along the lines of 8 to 10 months. So in Q4 of 2025, we should be fully completed with construction. At that point in time, and likely even in preparation of that, we're going to start finding tenants, leasing up. So in year 2, right here, we are planning that on average, we will have 25% occupancy. That is always a safe bet as you are leasing up. You are looking for more commercial tenants. And right here, you kind of see a breakdown of our annual expenses. There might be something here that you guys are a little bit less familiar with. It falls here in our expense reimbursement line item, and that is a triple net. So when you are getting retail tenants of this sort, they will pay a certain amount on top of their rent that will cover the expenses of the building, such as property taxes, insurance, utilities, some repairs and maintenance, making sure that our grounds are looking wonderful, that our parking lot is in good shape, things like that. Obviously, we also have our property management team that is leasing that all out. So in 2026, basically, we are planning on average to be 25% occupied. Moving forward to year 3, at that point in time, we expect to be fully stabilized. We have a little bit of, vacancy always planned in, because that is just a healthy thing to do in any scenario. But year 3, 2027, is also when we will be looking to sell once we are stabilized. At the moment, with the plan that we have in place, we are looking to sell this around $30 million at a 6.5 cap rate. And that would mean that for your investors, if they choose to invest in this deal, these would be their returns. Stryer, you want to jump in here and share a little bit more about that?
Yes, ma'am. So the difference between us, this one on the multifamily is the cycle time. It's about 3.5 years, multifamily 5.5 years, faster cycle time. This is class A, multifamily value add, typically not class A. So to think about the return perspective, on a class A and a multifamily, LPs get 15 to 17 because that's the price premium you pay because it's a class A. Class A retail, you get more because your risk profile a little bit different. It's about 21, 22. That's also because no depreciation there here versus you get some depreciation there. To offset that, this is a faster cycle. That is a longer cycle. So it's a balancing act. The risk profile on the new construction that's because everything is exposed to the market. That your labor cost exposed to the market, material price exposed to the market, then interest rate exposed to the market, whether we can find a tenant or not exposed to the market. Versus on the multifamily, there's a given tenant base. You're fighting for 10 or 15% of the traffic, not whole 100%. On the flip side, this is the worst time of the cycle. So, and we are paying the highest interest rate. That means we baked in 9%. And if something were to happen down the way, we get the benefit that is not into this business plan. Construction costs is on the top of the line. One of the things we say, we're gonna find somebody on the construction side. This is our realization. We're gonna have a cousin who can do it for cheaper. It's always there. You're never gonna get out of it. But the problem is the speed and the know-how and whether they can repeat the same thing over and over or not. That's the thing. On that note, we price everything on the retail. The Realty One has a construction company. It's called Option One. And the Option One will spend that $11 million to do this. They are price competitive. Can we find somebody $5-6, per square foot cheaper? Absolutely. But then they're gonna come back and get us some other way that we're not gonna even know. In this case, our finance team is baking into their finance team. So we have their backend data, so they're not going anywhere. So we have full control on the deal from that perspective. So the confidence level on the execution on the price is really, really high. So that's how we're looking at it. So it's a healthy project. When you do a new construction, you should expect 25 to 27 IRR at the project level, which is L35. So it is hitting about 27, 28 IRR. And LPs are pretty healthy. 21 in today's market, finding 21 is extremely tough. Some people can give you 25, 33, but look at the assumptions and you'll be surprised. So that's there. So 1.6 multiple, it's good. But again, this is the model. It doesn't bake in the 100% of the reality. So it has some sensitivity around it. So we're comfortable. We'll hit it. That 20 plus IRR, quick in and out, that's there. If you go all the way down the top a little bit, on the column L, stay in. So going in, it's a 70-30. Typically on a multifamily, we keep 70-30. Going out, once you hit the 17 IRR, this time it's typically on the new construction, this type of deal, it is not a 70-30. We put it at 50-50 because at the general partnership level, we are taking more risks. On a multifamily, somebody can come in, it's a non-recourse, and outcome is the same, but your balance sheet frees up quite a bit. In this case, balance sheet takes a hit quite a bit, and that is why it's a 50-50. So when you do adjustment, look at recourse versus non-recourse, and the power of the balance sheets and how much of a balance sheet dinks. So we kind of balance it out as you go. And then we also said 50-50 will hit in after 17%. Up until that, it's a 70-30. So our performance is aligned with the expected outcome. And we said we are going to perform. If we do perform, we split. If we don't, hey, get less off, right? So as a management team, if this is a $20 million company we're going to buy, our incentive to sell, it's aligned and the returns are aligned. So LPs are on a better side on, versus running an 80-20 deal or 85-25 deal. Okay. That's there. If you scroll down all the way to the left side, that's okay, please. Right now, the value improve ratio. So our all-in cost will be about $353 a square foot after we pay down everything, right? Our sales about $500 a square foot. Truth is somewhere in between, right? We may not hit that 353, we not hit that $500 a square foot. But the interesting part is our rent. We're going in at a 265, we're selling it at a 305. Sorry, $3 a square foot. $3 a square foot is pretty common. On the retail side, we were getting upwards of $40 on a solid class AA. Like our property is like a notch down from 1093. If this should be in the corner of 1093, we'd get $5 more on top of that. So that makes a lot of sense. And then value increase dollar per square foot, it's a 40% value, which means we are finishing the job at a 350. We are selling the job at a 490. So about 40% margin there. VIR, it's a value improvement ratio. We ask the question, hey, if we have multiple projects, where do I get my biggest bang of the capitals? So in this case, 40% is a very good number. And then it's more than multifamily. So we ask, hey, what's my return? Then the question is how much of a work we got to do? And then same amount of work, same return, then how much of a capital I need to bring. And that's how we measure the whole process. Okay, so that's there. So this project checks out overall return, LP level return, and also if we force rank this project with other project, that also checks out. That's about it for this one. So all in all, it's a very similar to multifamily. The difference will be on the P&L is first 1 year we have 100% vacant. Second year we have 75% vacant. Third year we're fully occupied. Cost side, we are not the client. We're not the owners. I mean, so we are the owners, but we're not paying the cost. So we have some management and some CAM, just common area maintenance. That's all we are paying. So my cost ratio is very skinny. So that's what it is. And we offset that because it's the area that we have taxes and insurance, and that we are the first one paying. Then you can always play that same area if the revenue is great with projects that we are not the first one paying the taxes and insurance, like Florida market. So that's how it is. Questions, comments, thoughts? And it was a lot, by the way. Some of you guys just joined, but there was a lot, by the way. So I appreciate you guys listening in.
And just to make sure, so on triple net retail, we talk about that a lot, but just to make it a little simpler description, the tenants on triple net retail pay the property expenses. So they pay pro rata their electric use, their maintenance, the electricity that's lighting the parking lot. They pay all of the costs, which makes it very safe. And they're also on a lease that guarantees they have to pay the cost, right? So they have to sign on that. So it's very much different than hoping you're going to get it, right? Because they've usually signed on a business, often signed personally. And so it really reduces the risk, because if property taxes go up, sorry, Mr. Tenant, the property taxes went up. It doesn't bother us. If insurance goes up, they have to pay it. So it's a really interesting way. And of course, we get out shortly after we're leased up, but it still is a really good investment. So just to make sure that people understood that.
Hey, Dennis, you're absolutely right. The full share area is definitely booming. Is very exciting location-wise where we're heading into.
I
Okay.
met with John, I think. We're expecting 2 to 3 of this kind of projects every year moving forward. It's a programmatic relationship with Realty One.
That's so exciting.
Sounds good. So okay, what do you call it? So we talked about the that's good. What else, Ellen?
I think that's all that we can share for now. I know we have a couple minutes left, so I do want to open up the floor for questions. At the end of the day, if you guys would be interested in raising on this, I know you're going to have to answer a lot of questions from your investors as well. So ask them to us so that you have the answers handy dandy ready to go. What is unclear? What can we help clarify for you?
I think at this
Mario,
point, Ellen, sorry, go ahead.
No, go ahead, Luis.
So at this point, the question that I would have, I always have this question, right? If I'm gonna talk to my investors, what should I tell them? And usually it comes down to not explaining everything, but explaining at least, if you invest 100K, this is what you're gonna get.
Right.
Okay.
So
Can
that's
you go down to return and the
yeah,
investor sample?
yeah, exactly. So if we can go through that would be awesome. So like, I'm always talking to them about, the stuff that we're doing. And they were, let me tell you, they were bummed that we couldn't close on Grove. They were like, "Oh, what happened?" I'm like, "Oh, well, we couldn't close." I did explain. I did go into a little bit of deeper conversation there, but they're like, "Yeah, waiting for the next one." I'm like, "Okay, I might have something for you."
Gotcha.
So
you're
did we
basically
talk
looking
about Grove here though, by the way? And did we Trevor or Maria, we talked about that's good
Yeah,
though.
you already.
Thank you.
Yeah.
So the returns are pretty simple, 1.6 your money. So give us $100,000 in 3 years, we're going to give you back $160,000. So if you think about it, a typical multifamily deal doubles your money in 5 years. This 1.6 is your money in 3 years. So it's a greater multiple, which
In less time,
represents
of course, in less
the way,
time. Yeah. Okay.
Yes. So there is always a tab here in the bottom called investor sample. It is based on $100,000. So if they put in 100,000, if all our numbers happen to be 100% correct and valid and true, that means that at the end of the road, at the time of sale, they're getting their 100,000 back and another $77,426. We'll make sure this also gets added in a easy variant in the presentation deck.
And that 77,000 actually includes the 2 previous years losses, or is that on top of? I mean, like that's 77 net, right? That's
It
counting
includes
the
everything.
losses, right?
Everything.
Okay, cool.
Yeah.
Cool.
Yeah.
So it's like
Yeah,
1.7.
and it also assumes that we hit the 50-50 split. So the total numbers assume that we have achieved everything. We've paid the full 7 pref.
Mhm.
And we've hit the greater than 17 IRR. So these numbers include a 50-50 payout, if that makes sense.
Sorry. And so because this is a new construction project, there's no distributions or of any sort. Capital is I guess recaptured at the sale at year 3, along with any realized profits.
That's
That's
correct.
Okay.
There's a teeny bit maybe in year 3, but very minimal.
This is where when you're talking to your investors, if this is confusing to them, this is where you throw back Horizon and you say Horizon is the typical multifamily property, 5-year hold. We've already closed on it, and returns are expected to be coming back quicker. We will be doing returns in year 1, and we've already taken it over. So like that is something to be able to talk about if this is confusing to some of your investors. So the nice thing is now that I mean, I hate to say the nice thing about losing growth, but the nice thing about losing growth is that you have 2 options to talk about. You can talk about Candela, but if a 3-year hold does not excite them because they're not getting paid out until year 3, then we can go back and say, but Horizon is already closed. It's a traditional multifamily property that is getting paid out. And yes, it's 5 years, but we'll have some cash flow. So you have those 2 options to talk about with your investors, and you have the opportunity that this deal did not go through, the Grove at Pinemont did not finish. So we're going to take the opportunity to have these 2 other deals to talk about. And remember, if they have tax problems, if they want depreciation, the only one is Horizon. Minimum investment will probably be around, I'm going to say, what, Trevor, 50 or 75 for Candela?
Minimum 75.
Oh,
75.
75%.
And I'm sorry, no depreciation because this is new construction?
Correct.
Yes.
And how long does that last? Say it's held for 10, 20 years. Is that indefinite for the initial owner, or?
No, how long? So let me kind of refresh. So you're asking how long we're gonna hold it, this project?
No.
Yeah.
No, when
Oh.
does the depreciation happen?
Oh, depreciation happen when you buy an existing building. We don't have an existing building. So if we were to keep this one, then we would have a depreciation when we do a refi.
I see. Thank you.
Because we have a building back then, we have a shell. But at the same time, more bathrooms, more kitchen, more the depreciation. Here you got a shell. So by design, you got less of a depreciation on the warehouse type of framework, right? It has maybe eight bathrooms, 10 bathrooms at best, and a bunch of ACs, but no kitchen, no toilet. I mean, not that many stuff. So yes, it's a little bit less to depreciate.
Less to depreciate than a traditional multifamily, which has a lot more bathrooms, as Trish talking about.
But next year it's gonna go away, hopefully. I mean, well, not hopefully, but hey, we got 40% depreciation. So this year the banking becomes important. So you'll be getting, depending on the circle that you hang out with. I already started getting phone call. Yesterday I got a phone call. Hey, I got $250,000. I like the Grove. I like the look and feel of it. Can I do it? I was like, okay, come to Horizon. It was like I looked at it, did some, but not anymore. I need another project. Then this one. Then I was like, nah, no depreciation. Then I have another friend the same way. He runs an IT company. He clears $1 to $2 million a year. This is the time. He sat down with Bill. It was like, sure, I'm dying. I was like, okay, we don't have Grow, but we have an office. So the office coming up that way. So just keep talking to investors and friends, and they will need your help. Whatever the case might be, they will need your help. And 30%, if we can defer 30% tax write-off, you made the money already. There
Right.
could be a 0 return, Like the project could have a zero return, but that's because they got the banking, the depreciation, they're in the money already. And then on
You're
top
right.
of that, you add the return, it really amplifies.
It's a good point. It's a good point, Shreya, that you mentioned it. If they need depreciation, they know they need depreciation. If they are a new investor who has no idea that they need depreciation, then maybe Candela is a great option for them because they don't know that they need it, or they might not need it because they don't have any passive income to offset because they are a W-2 employee and they don't have any passive income to offset. So maybe this is a great option for them. Or they're maybe using a 401k, a self-directed IRA, and they're not going to need the cash flow. So Candela, perfect option for them. This is why you have to ask these questions with your investors, why you need to know a lot about them, why you need to be asking those fact-finding questions. They're going to tell you, well, we're going to wait till after the election, or we're going to do that. No, that's really crap. They are just saying that to just get you off their back. You need to keep asking, keep kind of probing them and figure out what their real issue is. Is it taxes? Is it cash flow? Is it that they just want to grow their money? Do they want to grow fast? Candela is a great option for it. So those are types of questions we ask. I will be asking you some hard questions if you are capital raising. Do you have more upfront now? Do you have more 506B people? Do you have more 506C? The reason is exactly why Schreier was talking about. He showed you the underwriting. He showed you how the schedule is laying out. We need to know how many people, how much money we're bringing in after the first couple of webinars. So that's why I'm asking you those questions. It's not because I am greedy for money. I mean, obviously I am, but I'm not asking because I just need to know how much money we have. There's a reason behind these questions I'm asking. So don't think I'm just asking because I just need to know all of your information. I'm asking for a reason, and I just want to know how we're doing on the raise. So if Candela is awesome to you or is exciting to you, please let me know. I will be assuming that all of you are raising, unless you tell me no. So I'm so excited that all of you are raising on Candela. And I hope to see you all tonight at the Horizon webinar.
I'm going to do some work on the Horizon. I'll let you have to send a meeting notice out on.
I already sent it out to to most people.
Thank you.
It's already on your calendar.
I appreciate that. As we go, I know, Shreya, you sent an email out for the Buckner property. Yep. Or Holden Green. Do we have, you want to quickly take a look at it, what's my initial view looks like, and get a storyline? And Ellen, we can build the storyline and wrap that around, because I'm thinking I'll be in Dallas next week. Okay. I can walk this property and Amberwood and a bunch of other stuff. And also Dallas is coming up with some rain, I think, next week. So, okay.
That sounds good.
So,
and I do believe we were waiting on the T12 for that one, correct?
Yes, I should get it today.
Perfect.
All right. You want to do some backdrop on it? What's the storyline? And again, for everybody else, this is a close call. And everybody here on Asset Masters, maybe one or two of you guys are. We invited you guys in, completely honor code. Look, at some point we're gonna get into scenarios where we're looking at the same assets. Our ask, it's a hard ask. Come talk to us if you're doing the same thing, and we'll protect everybody as we go. But on that note, let's go talk openly. And so, what's the storyline for this one, if you don't mind?
Ooh.
Well, the owner he's run this asset into the ground. He purchased it back in 2020, principal and interest loan. I think it's at 2.8% interest. It's assumable. He has tried to partner with me to bring me into the deal with him. We just have not been able to agree on. We just can't get on the same page as far as a partnership. So he's wanting to sell outright. Approximately 46 units need a full rehab, and they've been vacant since he's purchased them. It's at about, I think, 70% occupancy right now.
Right now, let me see. Okay, so let me go back a little bit. Do you guys have a strike price with him?
What is that?
Like a price, like a tentative price, where you want to shake hands?
So he gave me an offer of, he said, hey, he'll sell that 12 million. This was about a week and a half ago.
Okay.
Then I think like this week he's at like 13.6 million.
I got it. Okay. So what we're gonna do here, we're gonna we know a PITI, he's in not a good spot, and we'll dig out the loan amount, and that's your starting point. In this case, you're not you are saving him from a foreclosure. In a sense, if you can buy the asset, then you are keeping him, you are allowing him to stay in the business for another 3-4 years and do more transactions. Because if the loan goes default, he'll be in a world of pain. So we'll walk in quick, fast. What we've seen for the negotiating perspective, it needs to be quick, it needs to be swift, and that seller knows what he's doing at this point. All bets are off. If I'd be in his shoes, I am trying. I'm talking to everybody like there is no tomorrow. So just know that that when you come into this, sellers are sophisticated, rightfully so. So that individual will be trying 24 hours to get everybody to get the most dollar out of it. For the play that you're gonna have, I know you, so I know the deal. Since I know the deal, my price and the term is based on the speed. That's what I would say. So I don't know how long. I mean, we have seen the seller property in the San Antonio one, but not this one. I think this one I haven't. I'll go dig it out. I'm gonna go from there. So is that a right statement that he is shopping around? Is that what it is? He has a broker in place, or he doesn't? Do you know?
Yeah, essentially he is. He had a group, he told me yesterday, that was touring the property. But yeah, for what it's worth, he would rather sell to me for what that's worth, but money talks, so. Okay.
So let's go with the $12 million for assumption, just to do the underwriting, then we can optimize as we go. So when we underwrite it, this is how we took a look at it. So this is the Red IQ. You'll get the access next week, based on the data right now, which is a little bit old, 7 months old. But let's say data is right. Let's pretend like data is right. It's about 50%, 45% occupied, so it's a bridge debt, and $12 million. I already have a lender in mind. That's a debt fund shop from Houston. They charge about 10 to 12%, but they'll give you 60, 70% leverage, but they're fast and they know the Dallas market. If we send them the property, they will tell you, hey, Shariah, go buy it or don't go buy it. And these are the reasons, these are the data points, because I'm seeing better price. So they're really good friend with ours. They're from Houston, so we run a lot of shops together. So I already have a lender in mind on this one if I need 75% of LTC to do the rehab. And you said 50%. In my mind, I already have a rehab crew in my mind from the Houston. They can go live there for a month, knock everything else out, and come back home. On that note, a quick question. I saw your website on your email. Do you own a flipping company as well, like a wholesale company, or you buy? Is that what you do?
Essentially, yeah, I do I do new construction, residential. So look, if we happen to get into this deal, like I've got people I can deploy and get started, and they could get those units turned within 4 to 6 months.
That's awesome. And when you say, let's talk through, when you say deployment, they're employees, or they're some other contractors you hired, and you have a.
Yeah, they're not employees, but they're almost like employees, so they exclusively work for me.
Beautiful. That's a fantastic superpower to have. That another way, what I heard is that those are the guys, if you need them at 2:00 in the morning, they'll show up with the cavalry, right? Yeah. That's the idea. Yes. So we have one as well, and it was interesting depending on the speed. So I'm comfortable less than 90 days. We can rehab almost everything between those two teams. We can come back up and running. So that's a speed that we have. Like, think about us too. We can knock that out as quick as fast, right? Let's see if your team does 20 in a month, our team can do 20 in a month. In the same month, 4 days done. Property looks beautiful, up and running, right? So that's good. So the construction issue resolved, lending issue resolved. So for underwriting, start with the 11%, 12%. I'll drop a text, Ellen. I'll let you know. So come Monday, we'll have a term sheet, like a directional term sheet as we kind of go. So that's there. So that's before I get into the operating statement. Something happened last year whenever he bought it, but there was a dramatic drop, and the drop never came back out. I'm guessing it still didn't come back out. So on that note here, I believe we have to run it as if it's a new development. We're coming in, we're running it whatever we think is right. The seller is not going to give it to you, or whatever he gives it to you, it's not going to make any sense. So to me, rent roll T12, in a sense, we have to craft it, and whatever we think is the best. We have enough data point to say how it's going to work, or how it potentially work, then we can kind of go from there. Because if you deal summary perspective, this is 157 units. This is a similar version of Pasadena, higher end than the Amberwood. I cannot use CAF, but we can use Cornerstone. So Ellen, we can take a version of Pasadena data and we say, hey, that data will mimic a version of this here, and we kind of go from there for cost purposes. Instruments, JT, tax, we can just keep it as is, what we have, and we go. So valuation perspective, we have to create it, Ellen. So let's just design one, then we kind of go from there. On that note, I looked at the summary cash flow, then operating statements, comms, and I could not find much of an asset here except one, which is the Lake Loft. So this is our own database. Lake Loft is the other side of the property. The freeway. That's a big one. We offered for almost $51 million for this one. We really like the location. We really love the location. But one of the interesting part is we know this side, but not the other side. And every freeways, it's a hard bridge. The way the west side will behave, east side will not behave the same way. So the question is, how is that going to behave? So I went back and used Justice Map. First thing, it's a $60,000 median income. 1/3 of that. That's a 20,000 divided by 12. The rent can be $1,200-$1,300 a month. So that checks out the box. Secondary thing, if I take a look at it, this side of the freeway on the west side, all blue, and the red is getting cornered into. That means all the riffraffs over time moved from here to here to here to here to here. And closer you get in the freeway, you're gonna get those type of properties, right? So they're getting boxed in. So if you buy anything on this side, it will be tough. If you buy anything on this side, you'll be okay over time in terms of that. On the flip side, this area is also getting better. So what happened is this is like high-end area. This is the gentrifying area. And there's two breaks. We have the 35 and we have this one. Oh, not the 35. We have 12 and we have 60. Sorry, 30. So that wedge right there is getting wedged in from the top. In other way, this quadrant is better than this quadrant, and this quadrant is slightly better than this quadrant, but this quadrant is the best. This is the second best, and the location that you have is right around here. So the location checks out, the strategy of the location checks out, and also what it tells us when we come in and run this property, it's gonna be a heavy-handed, tight takeover. It's not gonna be nice come in and do. So you're gonna get all sorts of problems you get in. You'll get drugs, you'll get fights, you get everything else on it. So when we come in, it's gonna be tight pickup, fast execution, and we go after building the exteriors, then we go after the culture, then we go after the tenant quality. So it's a layer down layer process. That's what I understand looking at this one. You have walked the property, right? So this area is kind of rough, I'm guessing. So I'll go put my eyes on it next week. And then we'll look at this one as you go.
I have, and for what it's worth, you can, yeah, sure, you can say that's an interstate, a highway, but it's actually just a street.
Yes, it's a heavy street. It's like a major
Yeah.
thoroughfare, right? Yeah, it's
Good
not a freeway.
traffic on that street.
Yeah,
Yeah.
good topic on this one. Yeah, typically if you got 4 lanes and close to some kind of bypass, they're a major thoroughfare. They just kind of sort of. Thank you. It's not. Then I came to the Google map. I said, let me take a look at it. It's not that hard of a break. It's a very similar characteristics. So what's going to happen is, without looking at it, I'm guessing this side and this side will mimic very similarly alongside you go. So that's the Google map, and this is this one. Those are flat roof, sign of older properties. This one has blended. I wasn't sure how that blending happened. Some pitch, some flat. But looking at it, this one is better than this one. Right. So anyways,
Yeah.
that's
half of the roof
go ahead.
is needing to be replaced
Okay.
on that building. So.
Okay. We have very good roofing team. So again, this is the reputation of what we have done, right? Horizon roof, Pasadena roof, and everything else. Hold on, I walked this property. I think I walked this property, but fine. So we have our team perspective CapEx. I'm not worried about it. I think between your team and our team, we can knock it out. But on the business plan, only do the pro forma give 4 months to finish the roof and the exterior capex and get the units ready. And then we'll have some vacancy between 4 months to 8 months. And then month number, the last quarter of the year, we should be able to close to the stabilization, and hopefully we'll refi in about 3 years, 2 years out. So we go in a bridge for 2 years, then we refi on a year 3. That's the business plan. And even though we go, if this deal is skinny first 2 years, which is okay, still should do it because rates gonna drop, we'll be in a better spot. And this is the heavy capex lift. So this is the good classic value add play.
Very interesting. And so like on a refi, so the current loan, of course, 2.8% interest. What's the, I guess, would that refi be for an interest only loan?
Okay,
Or would
so
that
let me
be?
go back. So thank you. So there's two things we have to see. So this is on the classic play. Now, I forgot the loan assumption part of it. This is the loan assumption. It's, let's say 2.8%. For simplicity, it's 3%. The issue that we get into, lower the interest rate, it is likelihood buyer will pay more money to buy this one, which you shouldn't. Because what happened? If I buy this property at a 3% interest rate, we know 3 years from now we'll be selling at a 5% interest rate. That means we have to work for free to improve the NOI to recoup the loss of price. Because for the same NOI, 3% gets you higher valuation, 5%, sorry, higher valuation, 5% gets you lower valuation. And then you got to work for free to buy a lower cap rate to sell at a higher cap rate. Then you have to work double to make profit out of it. So loan assumption, we always hesitant anything less than 4%, but this is the value add. So we're not entertaining in the price, we're listing what's the price is. So what we have to do is that look at the loan assumption and then look at how quickly we can stabilize and how much of a working capital, debt payment, yada, yada, yada. And then we have to ask a question, how quickly we can get a supplemental. Supplemental is your refi. Does it make
Sorry,
sense?
say that again. Supplemental is
So,
what?
Is your synthetic refi. Because you're taking a secondary loan on top of the primary loan from the same organization. So your aggregated interest rate is higher than what you're paying today. And then you can take some of the money out. And so setup perspective, great setup. Location checks out. Business plan checks out. Price, we don't know. CapEx, we can figure it out. So we have a property management company who can run it. We have a CapEx crew, we can get it done. Now we have to really park everything and make a hard offer end of next week, and we go. So I mean, point is we gotta be quick, right? He wants to get out, you wanna do it, put the dollar, put the money, and for us, we don't wanna do anything new, right? We're just gonna go knock it out quickly and we go. So to me, we should be able to pop out an offer by Tuesday, Wednesday next week. At best Thursday, an offer goes out with the hard, strong offer goes out that we all feel comfortable with. Okay, and look, one thing we need to share here, it's the existing loans docs, that what the terms are, and then when will that expire? How long do I have it? So that loan doc, just get that one. I think we'll be okay with the rest.
Okay, I'll work on that. And you said a hard money loan in place, and what is that going to cover? Approximately 75%?
So if you take a bridge debt, that's going to be 12% from a 3 to 12. So we have to pay 10% on a $10 million loan. That's a lot. That's $1 million loss, right? So it's easier for us to stay at a 2% on the assumption and bring in money. So in a sense, the way I take a look at it, we have, let's say 40 units. So we need about $1 million for CapEx. I'm just throwing some numbers out there, and about $500,000 for loan takeover. So I think between $2 to $3 million, we can take over this project if the number works out. So all in, let's do a number real quick. I'm just doing the back of the envelope, shooting my shots. Let me see what would they look like. And this is how I got it without. Hey, it's going over a little bit. Sorry. Anybody wants to drop off, you can, but I'll just wrap it up in 5 minutes. So this is what I'm thinking, what I'm looking for. Loan amount, what, 12 million?
Yes.
So again, I'm just throwing some Sorry, I got my own problem. When I do my Excel, I want my font a certain way, on my stuff a certain way. I picked up those bad habits and when I worked the corporate. So loan amount and this unit count will be 160, right? 159, right?
158, 159, yeah, 150.
158. So let's do 50. Measure minor. Life happens. All right, so 50, we do 20, then life happens. We'll add in 10 units. Exterior,
Currently,
we'll put some-
approximately 94 units are occupied currently.
man, 94 is about 30 of them will have dead bodies in there. You gotta kick them all out. It's just gonna be rough. You're gonna see half of them will not pay, and then they got bad apples, and somebody will be selling drugs somewhere. They're gonna fight. So just assume 30% of that will be gone anyways. That's why I said, hey, if it's 150 unit, hey, let's put just again, we're just going in just because, right? Unit and our unit cost. I'm just throwing some numbers out there. I don't know what they're right or wrong, but I'm just saying if I don't know, I don't know. I'll put $13,000, $3,000. Exterior. Okay, so it doesn't add up. Oh, it's not bad. Okay, so I assume it's $1 million capex, whatever we have, right? Let's just get 2 units out of the way. Okay, so let's say we have 900 grand, 800 grand of capex. What? Oh, sorry, working capital. Lack of cash. You put in another debt payment. Okay, this is our starting point. Again, I don't know right or wrong. This is our starting point. Then we'll go from there, right? So let's say we need $1 million with the capex.
Sorry, he's paying approximately the 70K out of pocket for what the
Per
loan,
month?
what the income's not generating monthly.
Okay. Monthly is 70. Okay, so something like that. Let's say 6 months. It's gonna. Let's say 6 months. Yeah, it's gonna take us 9 months, a year to stabilize, but 6 months we'll pay. The rest 6 months, I guess we'll break even, whatever assumption. So let's do 1.2. So we're looking at total that plus that, then that divided by it's 84K a door. I'm trying to see something really, really quick. Bear with me for a second. So, okay, sorry. Cancel, overview. Average size is 881, 157, 881. So total square footage is of 138,000. And then dollar per square foot will be, that's not bad. And the current rent is, what's the current rent right now?
It
Okay.
varies depending on
Right.
the square footage. They're all primarily 2-bed, 1-bath. They've got 2-bed, 2 baths, and
No worries,
1
we
bed,
got
1
it.
bath. So
Floor
on and so
plan, thank you. Right here, okay. So whatever the existing things are, per unit, dollar per square foot. So $136. I'm sorry, $1.36. So this project checks out if you can buy that at that price at $13 million because we're paying $95 a square foot. The 1% rule. My rent needs to be at 90 cents, but let's say rent needs to be about $1.10, but the current rent is about $1.30, which is a fantastic place to be in. So the way I take a look at it, my down and dirty version of it, times 1%. That's the top one, right? 1.2%. Okay. So at a minimum coming in, I would expect to have a rent of $1.14, then it's become skinny. $1.20 is really good deal because I'm coming in as a $1.14. That's my as is rent. I am going up to $1.30. So I have a 20 cents of value improvement just because I fixed the property. That's a big amount of spread to go after.
And this is at a purchase price of 12 million
Yeah,
or the 13.3?
13 million. 13.
13.3?
Yeah. Again, this is extremely back of the envelope. I just did a top down, just once a sense check perspective. To me, 95 cents a square foot versus the market rent is $1.30. So you know there's a gap in the property and it's a heavy handed takeover. The 1.3, maybe it's gonna take a little bit more, but 1.3, $1.4 million. I think, don't know the numbers yet, but let's put the numbers together. That makes sense. So Ellen, Wallington will run it. Then Joseph is gonna go there for CapEx. We got the roof guy from Pasadena. We got Sherry's team out there, and each team can do 15 to 20 rehabs. We can bid it out all things now, so we can knock out the whole thing quickly. Exterior will do a version of Horizon. Culture building will do a version of Pasadena Horizon. Timeline perspective, we know what Horizon works. Team distribution, we know how it works. So so deal team is ready. Now we have to design that deal and see if it makes sense. Then execution is easier than what it is right now.
Sounds like fun.
All right. And then you really want to play, right? You need to negotiate this one and San Antonio together.
Let's do it.
That's the beauty of it. You negotiate quick, negotiate fast, and and kind of go about it that way. Now it's uncomfortably ever after, right? He needs to give something, we need to give something. And then we can go, but the deal makes sense to me, the initial look. So Ellen, tomorrow, if you got time, we can underwrite this or later. Now I got Horizon in my mind. Tomorrow we can do the review. It's gonna take about 40 minutes or so. We can knock it out.
And I'll send you the financials for the San Antonio asset. He's still working. They've not agreed, Fannie, to I guess allow an assumption on that, even though the loan is assumable because of the position he's in, where they've accelerated the loan, kind of. But Fannie has agreed to allow an assumption for the Dallas asset.
Okay. So, and this is where balance sheet and resume will kick in. We can go back and say, look, our balance sheet, our team, it's stronger and better. We're not going to do it. Why don't you let us have it? Because they're looking at the bad boy carve out. He defaulted on that one. He's about to be defaulted on this one. Lender's giving them a hard time because for whatever reason they believe he's going to go mess up into both of them. And I think I could see why they would say that. And so he needs to, and from his job, he should have something happen. If you are a power play, if you are a decent player, you should have let the property go a long time ago. He single-handedly brought the property into such a worse place. He brought it down, right? That means it's a lack of decision. Without telling me, you told me that you could not make a choice in 9 months. Lender saw that. And he said, if we do it there, you're gonna do it here. So let's go take them all out both. I'm off the plate. That's all. Maybe life happens. Maybe something happened in his life. I don't know. But outside perspective, he just didn't make a decision.
Yeah, no, for instance, with the Dallas asset, his excuse was he got burned by 4 property management companies until he found the right property management company. So therefore he lost approximately $2 million. And so that's his excuse there. San Antonio, it's 90% occupied. The reason why Fannie has decided to accelerate both loans is simply not because of any delinquency in a financial sense. It's the delinquency in a sense of he not making the repairs to their satisfaction. He just said he's just dragged it out.
Yep. Same thing, right? Same behavior kicked in. He dragged it out there. He dragged it out here. He's getting away with that payments coming through. He's not getting away. You're going to find dead bodies into that property when you walk in the DFW area. You'll see the exact same thing in San Antonio. It's just bound to happen. So, hey, life happens. Maybe I don't know the individual. He's a fantastic guy. But on the business sense, he's showing you indication. And look, the lender doesn't show up that strong in today's market. They are busting their chops to have you keep the property. If they have showed up, we have done a lot of things wrong. That's the idea. So don't don't think like you're doing somebody a favor. I mean, you're doing somebody a favor. And that's what it is. So our role is the way we take a look at it. The most of the time when we go after this kind of upside down projects, some of our friends, they will go all out and take every single thing out of the process to get the thing, because they're like, you're dead man walking and I got the bottle of oxygen. But for us, we try to play a little bit gently. My thing is, if we can find a way to settle the property in a nicer way, so it's uncomfortable right now, but 3 years down the way, we are still friends, we can do deal together, that's the better way to go. So that's how we're gonna go and say, hey, look, you can get the $2 extra with somewhere else, but with us, we give you the certainty, and stick around with us. We'll find a way to do something. So there are a couple of options of negotiating that we can do, but let's just put a number out there. And from your side, get the term sheet for us. That's all we need for now. And an introduction to a lender, probably. Okay, cool. Thank you. Sorry, I went over 30 minutes. Did it help?
Oh, yeah, absolutely. Thank you for that.
I appreciate it. Okay, thanks everybody. Talk to you guys. Bye.
Thanks, everyone. Have a great day.